My name is Jason Adcock. I'm the Business Development Manager at Bluefin Professions in Bristol. A primary part of my day-to-day life is to manage the scheme facility you have for your membership. And I'm pleased to say in the room today there are quite a few of our clients. So if anyone would like to talk to us at a stand later, I'll be more than happy to speak to you. We've been challenged with the question today, is the PI market for accountants changing? I'm going to talk briefly about the PI market and how insurers and us as brokers see the market moving forward in the months ahead. I'm going to pass you over to Rob Morris, who works for a company called Reynolds Porter Chamberlain, and he's going to speak to you more in depth about the subject of risk and how to handle your risk more effectively and efficiently. As has just been said, this session is being filmed, so any questions thrown our way will be included in the recording. Appreciate we're running very close to time, and I'm hungry. I'm sure most of you are as well. So please feel free to come and talk to us again at the stand later this afternoon with any questions you may have. So, is it changing? Well, in the words of Harold Macmillan, you've never had it so good. You may laugh. For more than 10 years, accountancy PI premiums have consistently fallen. Now, there will be exceptions to the rule, I appreciate that. But on the most instances, for 10 years running, we've seen premiums fall and fall, to a stage now where some of the premiums we see can go really no further. Let's take a look at the market itself. We've been through and probably are still in the throes of a double-dip recession. Competition within the PI market has increased dramatically over the past few years, which has led to a softening of the market. Insurers, and our insurers are the same as any, have offered wider cover, which has driven down premiums purely to gain a greater share of the market. This in turn has led to the price war, which we now see resulting in falling premiums year on year. In fairness to you all, insurers still see the accountancy market as a good risk and still do have an appetite for the business. But some insurers obviously still do continue to offer annual premium reductions. But with claims from all areas of accountancy on the increase and on dramatic increases in fairness, the market, we believe, just cannot sustain this trend in the long term. I'll show you a little diagram here. We call it the time bomb of claims. And it just mirrors what I've said. Recession leads to a soft market. Increased regulation gives a wider scope for claims. Wider cover leads to lower premiums. And then the atomic bomb at the bottom, boom. Something has got to give. Sorry, one page too quickly. Rather than take my word for it, or Bluefin's word for it, I spoke to a number of A-rated insurers that are heavily involved in the PI market for accountants. And the story that came back was pretty much standard, and those 3 points there were the cleanest that I could include on the slide today. Losses are significant. Premiums have not increased to reflect that loss. And you could say that's the industry. They take the risk. But rates at the current level are becoming unsustainable. One insurer I did speak to, he kind of used 2 words to describe the market. I said, yeah, please go ahead. He said, it's dire. So take into that what you will. All of the insurers commented that it's the claims within more the standard forms of accountancy, not the things such as corporate finance or mergers, acquisitions. It's now basic accountancy where we're seeing an increase in claims. And that's where the problem stems from. So, and the answer, is the PI market changing? I think in the words of Bob Dylan, January 1964, the times they are about to change. I think we're close to seeing the market really bottom out. And although I don't expect premiums to rise immediately, significantly, I think we're getting to a point where we are going to see a shift in trend. And within such a weak market, insurers, like any business, become vulnerable. So what should you do as a practitioner? Work with a recognised and trusted broker stroke insurer that has a strong history and standing within the PI market. Reasons behind this are, as I said, more and more insurers have moved into the PI market trying to get a piece of the action, shall we say. Many have been caught out, thinking they're going to make a quick buck. They then see the claim scenario that's fired towards them and they can't sustain the loss. I'll use an example in the solicitors market. Quinn came into the market very heavily. were caught out dramatically by claims and sadly are no longer with us. I'm not saying that's going to happen for the accountancy market yet, but we have to be careful of where we're going. Purchase, and this isn't a sales pitch, believe me, it's not a Bluefin sales pitch. Purchase a policy that gives protection to the type of work that you're doing, now more than ever before. Don't simply focus on the price and the premium. Look at the benefits you're offered by your broker and the insurer. And probably more importantly, look at the back of house service you'll get should a claim be filed against you. We always believe at Bluefin that that's when the broker starts to earn his money, when a claim is filed. Again, this isn't a sales message to all. It's something that I hope you take very seriously. I know that you all do. It's meant as our opinion and the insurer's opinion of the overview of the PR market as it is now. And it's from both sides of the fence, the insurer and us from the broker. And it's really just an insight to how we see the market going in the months and maybe years ahead. But my underlying message to you is simple. Now more than ever before, manage your risk effectively and efficiently. Thank you very much for listening. I'm going to pass it over to Rob now. He's going to talk about risk management and how to handle it. Thank you very much indeed.
Good afternoon. Well, after Jason's bad news, at least there's some good news. It is nearly lunchtime. My name's Rob Morris. I'm a partner at Reynolds Porter Chamberlain, a firm of solicitors, and I deal with claims against professionals and in particular against accountants and financial advisors. As Jason said, one of the ways in which you can manage your professional indemnity insurance costs is to manage your risk. And by that I really mean, in this context, managing your business on a day-to-day basis in such a way that you reduce the prospects of any claims being made against you and maximise the possibility of resolving any claims that do arise as quickly as you can and as cheaply as you can. Now, very briefly, what are the sort of common claims that are made against accountants? Obviously, there's all kinds of things, but here are just some of the more common ones. Just from general day-to-day business, we see a lot of claims relating to administrative errors. So, for example, filing tax returns late. Then, of course, there are claims relating to more technical issues, for example, provision of incorrect tax advice. I put up here management accounting, and by that I really just mean claims are very common where accountants firms provide a very broad service for a client and the running of their business. And where that business starts to go wrong, it's often the case that the client will look to its accountant and try to apportion some blame. And finally, of course, there are claims arising out of audits. Now, following the credit crunch and the recession, there's also been an increase in claims relating to investments for obvious reasons and tax advice because of the revenue's hardening position, particularly in relation to tax avoidance schemes. Where clients go into insolvency, into liquidation or administration, claims are also on the increase as liquidators look around to see if they can make recoveries for creditors. And again, audit claims are on the rise because of increased losses and increased discovery of fraud. But really what I want to talk about is practical ways in which you can ensure, as far as you possibly can, that you avoid claims or you are put yourself in the best position to deal with those claims if they arise. Because if you do that, you'll save yourself time and money, and you'll save your insurers money, and ultimately that will be reflected in the premiums you pay in the years to come. Now, the way I propose to do this is by going through a case study. You'll find in your packs, at the end of the slides for this session, a very brief case study. Now, the case study is entirely fictional, as you will see. However, it is based entirely on real scenarios that I have either seen in cases I've dealt with, or in fact, unfortunately, they're things that I see regularly in cases I deal with. This is sort of a worst case scenario study. So we're a bit up against it for time. I was going to ask you to read through the case study in your packs, But perhaps I suggest if you read through the study and follow it, but I'll run through the main points. So first of all, we have Dave. Dave is an accountant, and he works for a very small, exclusive accountancy practice called Bullingdon & Co. Now, his mate from school, George, is an entrepreneur, and he has a business, suitably mass market business, called Luxury Duck Houses. Now, in the early years, Dave works for George on a pretty ad hoc basis. He just does anything George asks him to do. He has no written retainer letter with George at all. And things are going very nicely. They start to build up a good working relationship. In 2008, a little later on, Bullingdon's somewhat flighty risk manager, Nick, gets a het up because there is no written retainer letter, so he insists that Dave puts in place a written retainer with George. And the written retainer covers the provision of management accounts, preparation of financial statements and tax returns, and nothing else. Some years later, in 2010, another of George's schoolmates, Boris, presents him with a fabulous opportunity to buy his business, the Greater London Authority. Now, George thinks this is a stupendous opportunity for him, but he's got to move quickly. Unfortunately, Dave is on holiday, sunning himself in Bermuda, but he gets sent some financial statements for GLA by George, and because Dave wants to keep George happy, he decides he'll have a quick look at them in between pina coladas. So he looks at the financial statements. He can't see any particular issues in there. So he calls George and he says, I've looked at the financial statements. They seem to be okay as far as I can tell, but there's only so much you can tell from these things. You really ought to go and get some proper due diligence done on this company before you buy it. To which George responds, well, don't worry about that. I'm in a rush. And anyway, I've got this great law firm, G. Brown LLP. They're going to cover off all the different issues and make sure we've got appropriate warranties and protection. Dave thinks this is a bit risky, but he doesn't say anything. He wants to keep George happy, and he goes back to his sun lounger. Then, unfortunately, things start to get a bit difficult. The bottom falls out of the luxury duck house market, and George starts to have some business difficulties. One of which is, in 2011, he receives a very significant unforeseen VAT bill. And he turns around to Dave and he says, you should have told me about this. You should have warned me about this VAT liability. You should have given me some more advice on it. And Dave thinks, well, hang on a minute, you never asked me to talk to you about VAT, so I think this is silly. But he's a good client, so Dave decides he's just going to waive the fees for the last couple of quarters, just to keep him happy. Now, from a solicitor's perspective, when I'm faced with a claim or a complaint against an accountant and the allegation is that the accountant has failed to do something as opposed to has given some advice that is incorrect in some way, I always have to look initially at the scope of the accountant or any professional's duty of care. In other words, what was it that the professional was obliged to do and therefore could be held responsible for not doing? Well, without a written retainer letter, it is very, very difficult to establish what a professional's duty of care is. So in this instance, we have a scenario where Dave was doing work without any written retainer. He doesn't think he was really obliged to give any advice on VAT, but that's very difficult to prove without anything in writing. The other thing to note from this example is you've paid good money for your professional indemnity insurance policy. You do not want to jeopardise the cover that you should have from that policy. So, in this example, Dave receives his complaint from George. What he ought to do is tell his insurers about that complaint. It doesn't matter if he thinks that the complaint's not going to go anywhere, but he still needs to tell his insurers because it is a potential claim if it isn't an actual claim. Also in this example, Dave has agreed to waive his fees. Well, that could amount to a payment in respect of the complaint or even an admission of liability. And most of your insurance policies will prohibit you from doing that without first obtaining your insurer's approval. So the lesson here is always liaise with your insurance brokers and make sure your insurers are kept advised of any complaints or potential complaints that may arise. Now things get much worse. At the beginning of 2011, George discovers a very significant tax liability within the business he bought from Boris. And he's furious about it, and he blames Dave for not telling him to get proper due diligence done on the company or protect himself. Now, Dave himself is furious because he told George to go and get some due diligence done on the company, and George just couldn't be bothered to listen to him. But once again, we have a difficulty here about defining the scope of Bullingdon's duty of care. Now, you might say, well, hang on a minute, they've got a retainer letter by this point. The retainer letter only covered financial statements, management accounts, tax returns, doesn't say anything about advising on corporate purchases. But one important message to take away is that even if you have a written retainer, a written agreement with your client about what you are going to do, you can extend your duty of care through your actions and through the advice that you give. And in this instance, Dave has extended the scope of his duty of care by being asked for advice and giving it. Now, the difficulty he's in is that he didn't then confirm exactly what it was he was going to do, and perhaps more importantly, exactly what it was he was not going to do. He didn't confirm that in writing. Now, that doesn't have to be done in a long letter or any kind of formal document. It could have been done in an email. All he needed to do was take another break between Long Island iced teas and send George a quick email and say, as we discussed earlier, I had a quick look at the financial statements. I haven't had time to do anything else. As I mentioned, you really ought to go and get some further advice on this point. If he'd done that, this complaint might have been dealt with very easily. George may well have been put back in his box if he'd been presented with a copy of an email or something else in writing. And perhaps he could have been diverted so that he focused his attentions and his angst on the solicitors instead, which I'm sure you'll agree would be a much better outcome. It's also important to remember that the scope of your duty of care is not necessarily going to change or be limited just because you have to do something quickly, or just because you have another professional firm involved, like a solicitor's firm, or just because you don't charge a fee. There was a recent case where a solicitor's firm was successfully sued because someone came in off the street. The solicitor's firm gave her an hour's worth of free advice based on very limited information, but nevertheless, the client successfully sued the solicitors in respect of that advice because their duty of care was the same as if they had been on a full retainer that was properly paid for. You can restrict your duty of care at any time, but you need to do it in writing somewhere. And the in writing point comes back again all the time, because here we have, if you have a chance to read the case study, there was a dispute of evidence. So Dave has said to George, don't be so ridiculous, I told you to get due diligence in relation to this company. But George is asserting that Dave didn't say any such thing. George's recollection of the conversation was that Dave told him that everything was absolutely fine and that it was a great opportunity and he should jump at it and go for it. So there's a dispute as to evidence. Now, unfortunately, witness evidence is inherently unreliable. At the end of the day, you will be dependent upon the judge deciding whether he believes you as the professional or your client who is bringing the complaint against you. And that is not a position you want to be in. Contemporaneous written evidence makes all the difference. And again, it doesn't need to be anything fancy, but just a quick email following up a telephone conversation, recording key points that's then properly filed, whether in a paper file or on an electronic system, is absolutely crucial in dealing with claims and managing risk. Finally, it's important here to notice that professionals have something that has been referred to as a duty to warn. And here we have a classic example of a professional giving advice, go and get some due diligence, and the client refusing to follow that advice. Now you might think that, well, the professional can't possibly be to blame in that scenario because his advice has not been followed. But unfortunately that's not necessarily the case. Unless the professional then goes back and warns the client of the potential consequences of not following the advice, professionals can still be at risk of claims. So here, what we really wanted to see, what I would have wanted to see as a solicitor defending Dave, is that email after the conversation saying, I gave you some quick advice based on very limited information, I haven't agreed to do anything else for you, and by the way, if you don't follow my advice and get due diligence, you face a real risk of hidden liabilities with the company you're buying. If he'd done that, it would have taken 5 minutes and he would have a very good defence to the claim. As it is, he's got a ropey defence and a potential exposure to a large claim. Again, make sure you retain the protection of your professional indemnity insurance. In my case study, George complains initially in January, the beginning of this year, but Dave thinks it's just nonsense. Well, it doesn't really matter what you think about a complaint that your client may make. What matters is the complaint has been made, and you must tell your insurers of that, even if you think it's ridiculous. I've dealt with lots of claims that have had no merit whatsoever, and they've still cost a lot of money to resolve. So you must be sure to tell your insurers promptly, or at least if you have concerns and you don't know whether you need to tell your insurers, make sure you discuss it with your insurance broker because they'll be able to tell you what you need to do. Finally, in the example I give, some months go by and Dave thinks everything's been sorted, albeit he's been sacked. Dave's pretty annoyed about this, so he sues George for outstanding fees. And of course, the immediate response from George is to counterclaim for £1 million. Now, we all know this type of scenario happens, and the client is just trying to avoid paying your fees. But that doesn't mean that it isn't a claim that has been made against your practice, and again is something you need to tell your insurers about. So hopefully this scenario, you can read it again for your own amusement. It's obviously a worst case scenario, and you think it's ridiculous, but actually these things happen all the time, and they make my life in defending claims very difficult. And there are just a few things you can do to make things much, much easier should you ever have the misfortune to face a claim. There's also a list of top 10 risk management tips, which should just reflect some of the points that I mentioned, and that should be in your pack as well. Thankfully, it's lunchtime now. We'll leave you to it. If you've got any questions, we're very happy to take them, but we will also be in the room over lunch, so please come and talk to us then. Thank you.